So one way you can give away that 13.61 million, it doesn't necessarily need to be the 13 million. You can give away, you know, 7, 10, whatever. But in order to lock in the high exemption amount, you can take the exemption and put it into a spousal lifetime trust, which we call a SLAT. We really like our acronyms in the estate planning world, so you're going to see a lot of them in the next few slides. So what you do here is the donor spouse takes money, takes his or her own money, puts it in an irrevocable trust for the beneficiary spouse. And so the donor trust gives away the money. He or she has no more access, direct access to that money. And then the trust terms are what dictate how the beneficiary spouse can access the funds. So, you know, you can pay out all income. So any dividends and interest the trust generates has to be paid out to the surviving spouse. Or terms I see a lot used are health, education, maintenance, and support. So the trustee can make distributions to the beneficiary spouse, basically to allow that spouse to continue living in the manner in which they're accustomed. And then the donor spouse has that indirect access to the funds via the distributions made to the beneficiary spouse. The one thing you need to be very aware of here is if the beneficiary spouse dies, you know, unexpectedly, or if you get a divorce, that donor spouse loses all access to those funds. So you always want to make sure if you're going to make a gift like this that you can afford to not have access to those funds if something happens. The benefits of this kind of trust is once you put it into that trust, you use your exemption amounts. You don't have any exemption, or, you know, you've reduced your exemption by how much you put into that trust. But that trust, then all those assets are outside of your estate. And so, you know, if you live another 10 years after funding that trust and it grows $500,000, $1 million, that growth happens outside of your estate and is not subject to estate taxes. You can see you also take advantage of the higher exemption amount. You know, if you fund it now with the 13.6 million, you've locked in the exemption. So when it drops to 7 million, you've already given away the 13, almost 14 million without any gift tax issues. The spouse can have immediate access to the assets, again, via the terms that you put into the trust. It's very flexible how generous you can be to the spouse. And like I said, again, the growth remains outside of the estate. So going on to this next slide is kind of a good picture of how a SLAT might work. So again, you can see that donor spouse is putting money into that irrevocable trust. We do recommend, you know, giving away around, you know, 12, 13 million, just so you can lock in that exemption. And usually that donor spouse is also the one paying the income taxes on that trust. So by the trust not having to pay its own income taxes, you're actually kind of making a gift to the trust by paying its own taxes. So you're allowing more funds within that trust to continue to grow tax-free, or estate tax-free. And then the beneficiary spouse during his or her lifetime receives those distributions from the trust. You know, again, net income, and you can see that health, education, maintenance, and support. That's how most attorneys like to draft it. But if you want to be more restrictive or more generous, sometimes it's going to depend on what kind of trustee you name. But you can put more terms within that trust to allow the beneficiary spouse more or less access than that HEMS provision allows. And then upon that beneficiary spouse's death, remaining trust assets then go to your heirs. So it could be your children, nieces, nephews, family members, whoever. And so all of that passes estate tax free to those beneficiaries. And then you can keep it in trust for them so they can have the same distribution terms, again, the health, education, maintenance, and support. Or if you don't want them to have to deal with trust, you can also leave the assets to them outright. But basically, you are controlling, when you set up that SLAT, you are naming who those secondary beneficiaries are and ensuring that they're the ones that get the remaining assets of that trust when the beneficiary spouse dies.